This is the big day that we've all been waiting for, the Federal Reserve meeting at 2 p.m. They are going to release a statement that is absolutely critical. In fact, it might be the most important one all year long. The first thing we are going to talk about is the Fed and their actions. This is so key to understand. I'll break it all down for you in plain English. The second thing we need to look at is where are we right now? Where are the markets? Where's the economy? The third thing is the irrational exuberance. We've heard this term before, but I'm going to show you the statistics in chart form that are going to make a lot of sense. I've got all of that and more. Let's begin. So let's start right here. In closing out 2021, Powell needs room to maneuver. The Fed won't want to tie itself down, but the latest data should make markets brace for higher interest rates and medium-term inflation. I do believe that some level of action by the Federal Reserve is net positive to both the economy and the stock market if it's just a little bit. The concern here is if they have to increase too far, too fast. So this chart out of Bloomberg actually has quite a bit of data and a lot of charts. So I wanted to touch on these really quickly. Looking at this, producer price inflation measures are off the charts. You look at the PPI, you look at the CPI, you look at basically any different indicator, and it is off the charts. And these are manipulated as we see them, particularly the core inflation, core CPI, the PCE, and all of these different measures that are used by either the government or the central bank. And you see how excessive they do get sometimes despite all of that manipulation. Services prices are rising too. You could see that right here in this chart, the numbers, the dates, all that. Do not be so concerned about all this, okay? I'm just showing you the trends. Wage pressures for small businesses, higher record highs for businesses raising wages and planning to do so. That has increased as well. And we haven't seen anything like this before. In fact, I have heard from you, so many people that have simply quit their job, got hired at another place, and took a huge raise as a result. Many people are just walking out the door because their employer is not going to go and give them a 20% raise. But if they simply quit and go to the next place over, they're going to get what they want. And whatever it takes, I say, because inflation is running so hot today. On one side, the current employer is probably saying, I can't afford that. And the other employer is going to say, look, I need the position. We have so many positions that need to be filled. So this is the time for the employee to take advantage of the circumstances if they certainly are able to. Then you could look through here a problem. For small businesses, the fastest inflation since 1979 creates problems for the NFIB. This is the small business members. Of course, small businesses can't necessarily handle this. The big businesses, the Googles and the Amazons, they could probably handle it, but not the small guy. Faith in transitory lives on. According to the bond market and according to many players, they believe that, oh, don't worry, the Federal Reserve is going to take care of it all. So there's more charts in here. I could go on all day, in fact. But I wanted to look at this, what it means to you. Essentially, what we're looking at right now is that the plan won't necessarily be to try and constrain the economy while withdrawing support so rapidly that the Fed becomes a big drag on growth, the equivalent of slamming the brakes. Instead, it will be to stop helping the economy so much. And that's what the Federal Reserve needs to signal. We're not here to slow it down. We're here to simply ease off the gas. And as they use that example right here, the Fed is going to take their foot off the gas pedal. She said the new development at this meeting is that the stimulus deceleration will be happening even faster. And they have to do this and say, we're just going to be here just a little bit. So don't worry, don't freak out. Wholesale prices measured rose 9.6% in November from a year ago, the fastest pace on record. We've never seen anything like this. Imagine that. In many ways, if the measurements were done the way that they were back in 1970, we would say that this is worse. 1970s, those were known. hot inflation, we had, oil shocks, tensions, geopolitical events, all these different things. But today, because of the measurement being different, it isn't the same in some ways. But we're looking at it through a different lens. Okay? That's the whole point. Central bankers are the biggest risk to stocks in 2022. This is according to a Bloomberg News survey, but also the fund manager survey coming out of Bank of America is saying the same thing. We're talking about hundreds and hundreds of billions of dollars worth of money being managed, saying this, a policy mistake, as they like to talk about it. We'll see what happens, of course, what the Federal Reserve is going to do, but this is global. The issue is global. This happens to be the LIBOR rate, and I wanted to show you something here. Well, it is measured US dollars. Take a look right here. It dipped down to, let's say, 11.11, I should say, 0.11, but has now risen to nearly 0.2. So the rate, where it was basically at rock bottom, has nearly doubled over the last little while, over the past couple months. And so while LIBOR is being phased out, supposedly, it is still being used for hundreds of trillions of dollars of different financial instruments globally. So it is still important. So this is one type of interest rate. That's what that means in plain English. Bank of England plans to remove the interest rate rule for mortgages. This was sent to me by a subscriber. Just wanted to show you something. Bank wants to scrap the rule that borrowers must be able to afford the rate rise of 3 percentage points. So you've got this condition where, okay, if rates do rise, you need to be able to afford it at that particular, those terms. But that made it difficult for people to buy in. And especially people who are younger, people who are first-time home buyers, they can't buy in. So what do? Well, we simply get rid of that rule and make it a lot easier. Oh, there's no danger with that, right? My goodness. Some tapering acceleration is likely, but not as much as the FOMC hawks want. So you can read through this if you're interested, but essentially what they are talking about is that the increase in interest rates and the tapering are going to be there. It's going to happen, but it's not going to be at this super fast pace. So the market might initially overreact. As we can see during the last couple of trading days, market is very red. And you look at all of this. In fact, I could show you right now what has happened. It's red across the board. Okay? Taking a look at all of this, particularly in the small caps on the right-hand side here, this just shows us what's going on. Okay, let me just pull up the SPY. This is just some insight over the last little while. Market's been up and down, since actually over a month now. We've been basically at the same level. So this is important to note because the market is very worried about this meeting. I've been talking about this since the last meeting. Watch out. They're starting to taper. They're starting to reduce their balance sheet purchases. People said, no, they would not. But here we are. And it doesn't mean the long-term prospects, okay, or I should say medium-term prospects. That's a different story. This is really key, though. Look at this. Bloomberg Commodity Index has actually fallen below its support. This could be something. This could be something to watch. It has climbed off the bottom, but we have to see what happens in the coming weeks. Look what's happening to oil. Look at other commodities. You've got some, like lumber, that have risen considerably. And you've got oil that has been sort of bouncing around. It all depends. But the commodity index itself has broken down below this, and it has been using that support line for quite some time. S&P 500 long-term PE, the market right now today is at extreme levels, not just the S&P 500, but of course all of them. And you see, I talked about this many times before. Go back 2 years ago. We would be using year 2000 as a look at that. It's crazy. How could we ever see this? And it's a joke. But now today, on many different statistics, many indicators and ways to look at the markets and different assets, we've gone beyond it. But of course, there's an excuse. Every excuse in the book. Disruptors, Internet of Things, 5G, whatever. They just throw out these different terms, and it's supposed to be okay. Doesn't mean that the market can't go higher. It just means that we're in a wacky time frame. Percentage of members above the 200-day moving average. Okay, this gives us an indication of what's happening as it relates to each other. So you can look at it historically, but what if we look at it compared to the other data that's available? Only 35% of NASDAQ companies are above their 200-day moving average, with the NASDAQ at the all-time highs. So the NASDAQ right now at extreme levels, and yet we only see a handful of companies that are above their all-time high. It's not strength. When you look at the Goldman Sachs Breadth Index, declined substantially in recent months. Kind of a similar way to look at things. Essentially, all this means, plain English, is that you have very, very few stocks that are carrying the market. Okay? That's what it means. 35% of the S&P 500's year-to-date return has come from 5 stocks. 5 stocks. Is that strength? You've got the 500 stocks, but 5 of them are really carrying the market. It's never good. In fact, you can see, I'll show you in a second here, what happens in a historical sense when we see this. Microsoft, Google, Apple, Nvidia, Tesla generated 920 basis points of the S&P 500's 26% year-to-date return. So just look at this, the blue area, percentage of total SPX return, the S&P 500, largely being carried by just a few names. Look at that. I mean, 10% for Microsoft alone. It's just crazy. 10%. Okay, and we've seen this before, of course, not the first time this kind of thing has happened. But when we get to these times, usually there's a setback. Drawdowns tend to be larger after the breadth narrows sharply. That's a historic, that's just the way it is. That's not good. That's not a good thing. Breadth is weak relative to the S&P 500, and it's even worse for the NASDAQ. So I'm just trying to show you over and over and over again what we have going on. And what do you got? Like some insiders selling at the absolute perfect timing, like Elon Musk. He has sold a total of $12.7 billion worth of stock over the last 5 weeks. Perfectly timed. Whether it's a coincidence or not, that's besides the point. But things are crazy. In fact, they're so crazy. Shoppers are lining up at dawn for the open run on $9,500 Chanel bags. This is in South Korea. And what's happening now is the market's getting so hot and crazy that people are buying these Chanel bags and then they're just reselling them at a much higher level instantly because there's only a limited supply, and they buy the bag and they resell it. The resellers are going crazy. There's such demand. People are literally lining up like it's the latest iPhone or something. This is not a good sign of, a normal economy. That's not healthy. Okay, if somebody wants that Chanel bag, great. That's fine. But what we're doing here is basically flooding the markets, flooding the economy with cash, throwing it out there, making it easy. And then you have speculation. And whenever speculation runs rampant like this, problems arise. It's got nothing to do with Chanel or jewelry or luxury items, all that. It's every single thing that I cover, not on just this video, but on all of them. If you appreciated this information, simply hit that thumbs up button, support the channel. It's right down there. I do appreciate that very much. If you haven't seen this video yet, you definitely want to check it out. So just click it and I will see you there.